Have you saved over the years to accumulate a nice-sized nest egg for retirement? Are you interested in preserving as much of that nest egg as possible from the tax collectors? Well, tax planning is an essential tool in managing finances, especially for the wealthy. And remember that tax avoidance is legal, tax evasion is not. If you are a high net worth retiree looking to maintain the substantial wealth you have accumulated over your lifetime, well, then you've come to the right place because this podcast episode is for you. Hi, my name's John Gigliello, a certified financial planner with the Albany Financial Group, and you're listening to Invest in Knowledge, a podcast about all things financial. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. Only through education, action, and accountability can you build the confidence and security you need to live a satisfying life. Today I'm going to talk about tax planning for high net worth retirees. What is considered high net worth? Well, actually, it's not as much as you think. Generally, it includes anyone with liquid assets of at least $1 million, excluding primary residence. But many families below that threshold may also benefit from the tax planning advice I'm going to share today. In this episode, I will provide insight into 4 areas of tax planning for high net worth retirees. They would be Roth IRA conversions, tax-efficient investing, estate planning and trusts, and charitable giving. High net worth retirees in particular need to pay special attention to their planning strategies. Planning for taxes can help them control retirement income while leaving a legacy for their heirs with less concern for tax consequences. The substantial assets of high net worth retirees often mean they bear a heavier tax burden than average retirees. The key to managing their tax liability lies in creating a plan for taxes, utilizing various tax-efficient strategies, and remaining agile in response to changes in tax laws. First area I want to talk about is Roth IRA conversions, and they are an important consideration in a tax planning strategy. A Roth individual retirement account allows for tax-free growth and distribution, affording retirees a tax-advantageous means of growing and accessing retirement funds. However, converting pre-tax assets into a Roth IRA is a taxable event. Remember, the IRS is always going to want to get their tax money. High net worth retirees may find that performing a Roth conversion during lower income years or market downturns can help mitigate their tax impact. Here are other things to know about Roth IRA conversions. A Roth provides the flexibility to withdraw money when needed. There is no required minimum distribution for Roth IRAs. A Roth IRA conversion as part of an overall estate plan may help lessen the impact of estate taxes. You will have to pay income tax on the amount converted into the Roth IRA. And as a result, your adjusted gross income, or AGI, may increase in years when you perform Roth conversions. Tax-efficient strategies. This is another crucial aspect to consider in tax planning, utilizing tax-efficient strategies when investing. Investing for tax efficiency typically involves structuring your investment portfolio to take advantage of long-term capital gains tax rates, which are often lower than ordinary income tax rates. For example, assets such as an index fund, an exchange-traded fund, or ETF, or tax-managed funds are designed to mitigate the investor's tax liability because they trigger fewer capital gains. Other examples of tax-efficient investment strategies include Municipal bonds, where the interest income is not taxed at the federal level and may be tax exempt at the state level and also local level. Treasury bonds and Series I bonds both are tax exempt from state and local taxes. The third area is estate planning and trusts. So beyond income tax, high net worth retirees must consider estate tax implications. Estates valued above the federal estate tax exemption level are subject to estate tax rates. Now, the federal exemption is currently at $13.6 million for individuals and $27 million for married couples, quite high. But when the 2017 Tax Cuts and Jobs Act sunsets in 2026, those exemption amounts may be much lower, making many more estates subject to tax. High net worth retirees must understand the inheritance regulations can differ significantly from state to state within the United States, often creating considerable complexity for heirs, executors, and legal and tax professionals. Not all states in the U.S. impose an estate tax. Some have no estate taxes, while others may levy a tax of up to 20% of the estate's value. States like New York, Massachusetts, and Oregon impose estate taxes, while others like Florida and Nevada do not. Some states even have an inheritance tax levied on the estate's heirs, which can also vary widely from state to state. Because estate laws vary from state to state, high net worth retirees must work with financial, legal, and tax professionals to help navigate these complex laws. Knowing these laws and preparing your estate to address them may help align the distribution of your estate with your wishes while preserving your legacy. Trusts, such as a bypass or dynasty trust, may be suitable tools for managing estate tax liability and preserving wealth for future generations. Various types of trusts may be appropriate depending on the needs of the benefactor, heirs, and goals of the trust. Here are some types of trusts often used in estate planning due to their tax benefits. Irrevocable trusts. The assets move out of your estate and the trust pays its income tax and files a separate return. Irrevocable trusts may provide high net worth retirees and heirs protection from creditors and estate taxes. There are two types of irrevocable trusts. A living trust, which is originated and funded by an individual during their lifetime, and testamentary trusts, which is irrevocable by design because it is created after the death of its creator and is funded from the deceased's estate according to the terms of the will. A charitable remainder trust. A charitable remainder trust can provide an income stream for the donor while passing the remainder to charity, effectively reducing the estate tax liability. Now, trusts are complex legal vehicles that pass assets to heirs as part of an estate planning strategy. Therefore, high net worth retirees must work with legal, tax, and financial professionals to help them better understand which type of trust is appropriate for their situation. And lastly, charitable giving. It may also be an appropriate tax planning strategy for high net worth retirees. Charitable donations not only support worthy causes, but may provide substantial tax benefits, particularly for high net worth retirees. Numerous tax-efficient strategies offer tax benefits to the donor, such as qualified charitable distributions, or QCDs. For high net worth retirees who must take an annual required minimum distribution from their IRA, a QCD can transfer a portion or all of their RMD directly from their IRA to a qualified charitable organization. By doing so, the portion of the RMD given to charity is not taxable as income. Another way is through a donor-advised fund, or a DAF. A donor-advised fund is a philanthropic vehicle that provides an immediate tax benefit to the donor. DAFs allow donors to decide where their funds may make the most impact. And lastly, establish a foundation. A private foundation allows high net worth retirees control over funding by directing funds towards targeted purposes over an extended period, ensuring one's financial contributions provide a sustained effect. High net worth retirees may find it beneficial to work with tax, legal, and financial professionals who understand the complexities of charitable giving as a tax planning strategy and the latest tax laws and regulations. Okay, so we've covered a lot of ground today, but to sum it up, high net worth retirees may consider using Roth conversions, tax-efficient investments, estate planning, trusts, charitable giving, and other strategies that I have not even discussed today to help alleviate their tax burden. It is vital that high net worth retirees mitigate their tax liability to maintain their standard of living and to make a lasting impact through their estate and charitable contributions. While tax planning can be complex, implementing a suitable approach, complemented by working with financial professionals, may provide tax savings and pave the way for a comfortable retirement. As always, we urge you to reach out to a professional to discuss your particular situation and goals. We always encourage you to take part in the financial planning process to pursue a confident financial future and, in turn, feel optimistic and proud about your accomplishments. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal challenge into a gratifying journey. If you have any questions about this topic or any financial matters, don't hesitate to reach out to us. And if you found value from this episode of Invest in Knowledge, I encourage you to share it with your friends, family, and colleagues. Lastly, I would like to wish everyone a Merry Christmas and Happy Holidays. And remember not to take this time of year for granted, because trust me, time passes before you know it. Thanks for listening, and have a great day. Material for this episode was derived from an article prepared by Fresh Finance, using the sources Investopedia.com and actec.org. John Gigliello is a registered and representative with, and securities are offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. The opinions voiced in this material are for general information only, are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult your financial professional prior to investing. Traditional IRA account owners should consider the tax ramifications, age and income restrictions in regards to executing a conversion from a traditional IRA to a Roth IRA. Although exchange-traded funds are designed to provide investment results that generally correspond to the price and yield performance of their respective underlying indices, the trust may not be able to exactly replicate performance of the indices because of trust expenses and other factors. Municipal bonds are subject to availability and change in price. They are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Interest income may be subject to the alternative minimum tax. Municipal bonds are federally tax-free, but other state and local taxes may apply. If sold prior to maturity, capital gains tax could apply. Government bonds and treasury bills are guaranteed by the U.S. government as to the timely payment of principal and interest, and, if held to maturity, offer a fixed rate return of fixed principal value. Government bonds and treasury bills are guaranteed by the U.S. government as to the timely payment of principal and interest, and, if held to maturity, offer a fixed rate of return and fixed principal value. Series I bonds are guaranteed by the U.S. government as to the timely payment of principal and interest and offer a fixed rate of return and fixed principal value. Minimum term of ownership applies. Early redemption penalties may apply. LPL Financial representatives offer access to trust services through the private trust company NA, an affiliate of LPL Financial. All information is believed to be from reliable sources. However, LPL Financial makes no representation as to its completeness or accuracy.